$50,000 embedded in your international dividend ETF could force liquidate without your consent the moment EU sanctions lock in, and you'll owe capital gains taxes on a sale you never authorized. That's the reality buried in prospectus language most investors never read. Here's why this matters right now. EU sanctions negotiations on Israel's finance sector are active. Once announced, fund compliance officers have 30 to 90 days to execute forced liquidations. That window compresses your rebalancing decision into weeks. Miss it, and you're holding the liquidation bag. But most investors don't even know the clock is ticking. Let's pull the actual prospectus language. iShares MSky Akux ETF, developed ex-US exposure, heavily held by US dividend investors, contains this clause. The fund shall not purchase or hold securities of issuers, if such purchase or holding would result in a violation of applicable laws or sanctions regimes. The operative phrase, shall not hold, that's not discretionary, that's mandatory. Vanguard FC Developed Markets ETF, $200+ billion in assets, carries identical language. Invesco ETF, same structure. When a sanctions list updates and an Israeli bank hits it, the fund is legally obligated to sell. The fund manager doesn't ask for permission. The law doesn't care if you disagree with the sanctions. The sale executes. And this is the moment where most investors lose control. Here's the math that hits your taxes. $500,000 allocation to international dividend ETFs with 10% Israeli financial sector exposure equals $50,000 in concentrated position. That position has been building gains for 8 years. Embedded gain, 40%. That's $20,000 in unrealized gains, all sitting in one forced liquidation trigger. When the fund sells, you recognize the $20,000 capital gain in your tax year. Long-term rate at 20%. You owe $4,000. But if you're in a 32% marginal bracket, or if the gain pushes you into net investment income tax territory, you could owe $500 to $7,200 on that single liquidation. And remember, that's just the federal tax piece. If you're holding this ETF in a margin account, forced liquidation also triggers a margin call. Your broker automatically liquidates other positions to meet the requirement. One forced sale cascades into two. Your tax bill doubles before you even realize what happened. But here's where it gets worse. The 30-90-day window between sanctions announcement and forced sale execution is when institutional money exits first. Data from EU capital flight patterns shows SWFs and large pension funds pre-position exits before retail even knows the clause exists. Their compliance teams monitor geopolitical risk 24/7. Your prospectus warning. You found it by accident in a YouTube video. By the time the forced sale notice hits your brokerage account, the bid-ask spread on Israeli financial positions has already widened 200 to 400 basis points. Your fund manager executes at whatever price exists on day 60 of the liquidation window. On a $50,000 position, a 300 basis point spread costs you $1,500 right there. You don't get to wait for a rebound. You don't get to rebalance into something else. You're sold at the worst possible moment by definition. The alternative isn't to sell everything today. It's to know exactly what you hold and when the cascade window opens. Here's the action. Pull your 3 largest international ETF prospectuses right now. Search for the phrases sanctions, applicable laws, shall not hold, and AFAC. Note the language. Calculate your position size and embedded gain. Run that gain through your marginal tax bracket. Then, and this is critical, set a calendar alert 90 days before any EU sanctions announcement for your sector. That gives you the decision window before the fund gets the compliance notice. That's your 90 days to rebalance into non-sanctionable positions. One more thing. If you hold EU-domiciled ETFs directly, not US-listed versions, your forced liquidation risk is even higher because EU funds face additional compliance layers and different settlement rules. Check the domicile on your ETF prospectus first page. If it says Dublin or Luxembourg, your liquidation clock runs faster than US-listed equivalents. Same facts, different reading. Follow the trail.